here's a quick thought experiment. You're 68 years old. You've been retired for 3 years. Social Security is covering about 60% of your monthly expenses. The rest comes from your IRA. $850,000 at retirement, now sitting at $920,000 because the market has been good. You feel fine. Your portfolio is actually larger than when you retired. Your advisor says you're in good shape. Now, take your $920,000, project it forward at 6% annual growth for 5 more years, with no withdrawals other than your current lifestyle draw. Your IRA at 73 is approximately $1.1 million. You divide that by 26.5, which is the IRS life expectancy factor for a 73-year-old. Your first required minimum distribution, approximately $41,500. Add that to your Social Security income, add any other income you have. Now check your tax bracket. If that number just shifted your tax picture in a way you weren't expecting, this episode is for you. Welcome, welcome, welcome. You're listening to The Income Standard, where retirement income is designed, not guessed. I am Tod Long, and this is the show for people who are done accumulating and ready to start engineering. Let's get into it. Welcome in, everybody. This subject today is something that I talk about to clients a lot. As a matter of fact, I have a lot of folks that I'm talking to actually this week on this subject, and it's required minimum distributions, RMDs. These are one of the most misunderstood mechanisms in retirement tax planning. Most people think of them as a tax event that happens at 73. Take the distributions, pay the tax, move on. That framing makes them feel unavoidable, inevitable, a fixed cost of having saved well. That framing is wrong and expensive. RMDs are not a fixed event. They're the outcome of a calculation, your pre-tax account balance divided by an IRS life expectancy factor. The larger your pre-tax balance at 73, the larger your mandatory distribution. And here's the problem. For most people who've been saving diligently and compounding for 30 years, the IRA balance at 73 is meaningfully larger than they expected. The market grows it. Contribution limits increase. And nobody proactively addressed the pre-tax balance in the years before RMDs begin. So at 73, the IRS hands you a forced withdrawal you may not need and taxes you on it as ordinary income in the same year as your Social Security and any other income you're receiving. That forced income can push you into a higher marginal tax bracket. It can trigger IRMAA, which is the income-related adjustments to your Medicare Part B and Part D premiums, adding $1,000 to $6,000 in healthcare surcharges annually. And it can cause up to 85% of your Social Security benefits to become taxable, which is a threshold that many retirees hadn't planned to cross. The RMD tax impact isn't one thing. It's 3 things happening simultaneously: bracket push, IRMAA exposure, and Social Security taxation, all at once, in the year you least expected a complex tax picture. Here's the insight that changes the RMD conversation. RMDs are not a retirement tax event. They're the result of a pre-retirement planning gap. The tax at 73 was built in the years before 73. Every year that pre-tax dollars accumulated in an IRA or 401k, any other kind of qualified account, without a tax diversification strategy. The RMD is just when that gap becomes visible, which means the fix is also in the years before 73, specifically the window between retirement and the year RMDs begin. That window is the most powerful tax planning opportunity most people never use. So when you retire, typically between 62 and 67, your income often drops sharply. Social Security may not have started yet, earned income is gone or reduced. If you're drawing from Roth accounts or taxable accounts, your reportable income is low. For many retirees, that window represents several years of unusually low marginal tax rates. Years when you could convert pre-tax IRA money to Roth at 12 or 22% marginal rate instead of watching it compound in the IRA and face a forced distribution at a 32 or a 35 rate decades later. The pre-RMD window is not just a tax optimization opportunity. It's the only window where you can proactively reduce the size of the RMD that will hit you at 73. Every year in that window is irreplaceable. A Roth conversion done at 65 in a 22% bracket eliminates that dollar from the RMD calculations entirely and allows it to compound tax-free for the rest of your life. Every year you don't use that window, the IRA grows larger. The projected RMDs grows larger. And the tax bill at 73 compounds. I want to spend a few minutes on the IRMAA dimensions specifically, because it's the one that catches the most people off guard. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a Medicare premium surcharge that applies when your modified adjusted gross income crosses specific thresholds. The 2026 thresholds for individuals are as follows. Income below $109,000. Standard Medicare Part B premium of $202 per month. It's actually $202.90 per month. You cross that $109,000 and the premium jumps to $284.10. You cross $137,000, it becomes $405.80. You cross $171,000, that premium goes up to $486 per month. Now, if you make over $205,000 as an individual or above, that premium is $689.90 per month. For married couples filing jointly, those thresholds are roughly doubled. Now, here's the trap. IRMAA is based on your income from 2 years prior. So your Medicare premiums at 73 is based on your income at 71, which means the year your first large RMD hits, which is 73, you're already paying IRMAA based on the income that hit at 71 from earlier distributions. And the RMD at 73 sets your IRMAA for 75. Once you're in the IRMAA surcharge tier, the elevated Medicare premiums compounds forward. Each large RMD extends your time in that surcharge tier. And the surcharge tier isn't just Part B. It applies to Part D prescription coverage as well. For married couples with a large IRA, sustained IRMAA exposure can cost $6,000 to $12,000 per year in Medicare surcharges on top of the income tax from the RMD itself. So the income tax bill isn't just your income tax rate times the distribution. It's your income tax rate plus IRMAA exposure plus the taxation of up to 85% of your Social Security benefit simultaneously. If you're between 60 and 70, your IRA is growing and nobody has run your projected RMDs against these thresholds, your conversion window is open right now. The question is, how many years of it have you already let pass? The income standard treats the pre-RMD window as a structural planning opportunity, not an optional tax optimization. for every client with meaningful pre-tax IRA exposure. In practice, that means two things. First, every income standard review for someone between 60 and 72 years old includes a projected RMD analysis. We project the IRA balance to 73 at current growth rates, calculate the first mandatory distribution, and show the tax impact against your projected income picture at that age. Second, we model the conversion window. How many years remain between now and 73? What Roth conversion amounts are feasible in your current bracket without pushing you into the next tier? And what the projected RMD reduction is for each year of proactive conversion. The goal isn't to eliminate all pre-tax dollars. There are situations where maintaining some traditional IRA balance is appropriate, particularly for charitable giving strategies and estate planning. The goal is to make sure the balance at 73 is what you choose, not what you accumulated by default. Proactive Roth conversion during the pre-RMD window is one of the highest value tax planning moves available to pre-retirees. It's also one of the most time sensitive because the window closes at 73 whether you used it or not. We are at the halfway point, and this is the right place to stop. We've established what RMDs are and why the tax impact at 73 is more than most people expect. The forced withdrawals, the bracket push, the IRMAA exposure, the Social Security taxation that hits simultaneously. What I want you to do right now is project yours. Go to the incomestandard.com and find the RMD projection on the resources page. You enter your current pre-tax IRA balance, your current age, and your expected annual return. The projector shows you what your IRA balance will be at 73, what your first mandatory distribution will be, and how that distribution interacts with your Social Security income to estimate your tax bracket impact. It also shows you how many years remain in your conversion window, the time between now and 73, where proactive Roth conversions can meaningfully reduce that first RMD. Most people running this for the first time discover that their projected RMD is significantly larger than they expected, and that the tax bracket impact is not a minor line item. If you're driving, come back to it. If you have 4 minutes right now, your conversion window is open today. It won't be forever. Theincomestandard.com, resources, RMD projector. I'll be here when you get back. Let me walk you through a scenario that shows the full RMD tax cascade and what proactive planning in the conversion window changes. Of course, as usual, they're my scenario segments. Names have been changed to protect the privacy. James is 64 years old, recently retired. He has $1.1 million in a traditional IRA, $85,000 in a Roth, and Social Security of $34,000 a year starting at age 66. His annual expenses are $72,000. He's drawing about $38,000 a year from the IRA to bridge the gap until Social Security starts. His projected IRA balance at 73 is $1.28 million after withdrawals. The account has still grown because the return exceeds the draw rate. His first mandatory RMD at 73 on $1.28 million, you take $1.28 million divided by 26.5, and that equals $48,300. At 73, James's income picture looks like this. His Social Security is $34,000 a year, now fully started. His RMD is $48,300 we just calculated. That total gross is $82,300. At $82,300 in combined income, up to 85% of his Social Security becomes taxable. That's $28,900 of previously non-taxable income now in the ordinary income calculation. Effective taxable income, approximately $77,000 after standard deductions. Marginal tax bracket is at 22%. IRMAA, at $82,300, James isn't above the 103 individual threshold, at least not yet. But in a year where his IRA income includes a large discretionary withdrawal alongside the RMD, consider car, roof, vacation, it's a threshold he can cross, which would trigger the first IRMAA tier. Total first-year RMD tax impact, approximately $10,400 in federal income tax on the RMD itself, plus the phantom bracket shift from the Social Security inclusion, effective tax rate on the RMD, roughly 21%. Now, here's what happens if James uses the conversion window. Between 64 and 66, James's income is roughly $38,000 from the IRA draw, no Social Security yet. His taxable income is low. He can convert $35,000 to $40,000 per year from the IRA to Roth at a 12% marginal rate without approaching the 22% threshold. If he converts $38,000 annually for 9 years, from 64 to 73, total conversions, $342,000, all at 12 to 22% tax rate. Projected IRA balance at 73 after conversions, $890,000 instead of 1.28. The first mandatory RMD at 73, let's calculate it. $890,000 divided by 26.5 equals $33,600 instead of $48,300. At $33,600 RMD plus the $34,000 Social Security, James stays in the 12% bracket, keeps Social Security taxation lower, and stays well below the IRMAA thresholds. The conversion window reduced his annual RMD by $14,700. Over a 20-year RMD period, that's over $290,000 in distributions that never happened. And the tax on those distributions that was never owed. James's situation is the norm. It is not the exception. A large IRA, a planning window that's been open and unused, and a projected RMD that nobody modeled until it was close enough to feel urgent. If your IRA balance is above $500,000 and you're between 60 and 72 years old, your window is open now. The question is, how much of it is still left? Let me show you what happens to James if the conversion window goes unused. At age 64 to 66, James draws from the IRA at $38,000 per year. His marginal rate is 12%. He pays $4,560 per year in federal income tax on those distributions. Total tax in the 2-year bridge is roughly $9,100. Very, very manageable. Age 66 to 73, Social Security starts. James now draws less from the IRA, maybe $25,000 annually. At this point, the IRA is growing faster than it's being withdrawn. He's in a comfortable income picture. The conversion window is open and quiet. Nothing urgent is happening. At 73, first RMD is at $48,300. James adds that to his $34,000 Social Security. The Social Security inclusion formula activates. IRMAA is very close. It's not there yet. His effective federal tax bill on RMD is approximately $10,400. At 75, the RMDs grow. IRA has continued compounding. Now $51,000 forced RMD. James crosses the first IRMAA tier. Medicare Part B premium increases from $174 to $244 per month, $839 per year in additional healthcare costs. At age 80, the RMDs are now $62,000 a year as the IRS life expectancy factor decreases with age. James is firmly in the 22% bracket, and IRMAA exposure continues. Over a 20-year RMD period, age 73 to 93, the cumulative federal tax on distributions James didn't need and didn't choose, approximately $190,000. The IRMAA surcharges over the same period, approximately $50,000. Total avoidable tax cost, $240,000. $240,000 built in silence across 9 years of unused conversion window and 20 years of forced distributions. not lost in the market, not stolen, paid in full to the IRS on income that was never planned for. The conversion window doesn't announce itself. It opens quietly and closes at 73, whether you used it or not. If you're in the window right now, if you're between 60 and 72 with a meaningful pre-tax IRA, the question isn't whether Roth conversions make sense in the abstract. It's how many years of that window you still have left and what you want to do with them. The RMD tax bill at 73 is not something that happens to you. It's something that was built in the years before 73 and can still be reduced in the years remaining before it arrives. The Income Standard Review includes an RMD projection and conversion window analysis for every client with meaningful pre-tax IRA exposure. We show you your projected balance at 73, your first mandatory distribution, and the estimated tax cascade. That's the bracket impact, the IRMAA exposure, and Social Security taxation, all in a single picture. And we model the conversion opportunity, how many years remains, what conversion amounts make sense in your current bracket, and what the projected RMD reduction is for each year of the proactive action. This conversation is for people who are still in the window, who are close enough to 73 that the urgency is real, but far enough from it that meaningful action is still possible. If that's you, don't let another year close without at least knowing what the window is worth. Schedule your RMD analysis at theincomestandard.com. The window is open. It won't be forever. That is the income standard for this week, folks. If this episode gave you a framework you didn't have before, share it with someone who actually needs it. Forward it to a friend who's 5 years from retirement and still thinking in terms of balance sheets instead of income architecture. And if you found yourself thinking about your own income floor while listening, like what's guaranteed, what's not, and what that gap might be, that's the signal. That's when this review makes sense. The review is waiting for you at theincomestandard.com. Again, that is theincomestandard.com. There's no cost, there's no pitch, just measurement. I'm Tod Long. We'll talk to you next week.